Okay, so one more practice problem with our money market and involving both money demand and money supply. This is one that the AP exam again loves to ask, and it really tends to throw students for a loop. So we can work through the various pieces of what's going on here. So first, draw money market in current equilibrium at R1. We begin, of course, with a nominal interest rate on the vertical axis, quantity of money on the horizontal axis. Our money market has a vertical money supply curve and a downward sloping money demand curve. As GDP in the economy increases, what effect would this have on the money market and nominal interest rate R2? We're looking at GDP here. We're not looking at actions by the Fed. The money supply, remember, is controlled by the Fed. So a change in GDP is not going to be a change to our money supply. Rather, a change in GDP is going to be a change to money demand. And as real GDP increases, money demand increases as well, as the increase in expenditures and the increase in purchases in the economy leads more people to demand money. So we can shift our money demand curve to the right, show an increase, and we can show a movement from RE to R2. So part 2 shows us that increasing GDP increases money demand, and increasing money demand increases our real interest rate. And then we get to the part that tends to throw students for slightly more of a loop. And I think the piece here is that we have to remember that we are dealing now with MD2, this new money demand curve, and not the original money demand. So if the Fed wants to keep interest rates at R1 or at RE, identify one monetary policy that could return rates to R1 and demonstrate the consequence on the money market. So first, now we are talking about the Fed, which means we are talking about the money supply. And the Fed has a goal to get us back to R1. But R1 now exists here on MD2. So if the Fed wants to increase, or if the Fed wants to decrease interest rates, right, from R2 to R1 represents a decrease in the interest rate, then the Fed needs to increase the money supply. An increase in the money supply can create a decrease in our nominal interest rate. And we can see that again on this graph. R1 now exists here on MD2. So in order to get back to R1, this money supply has to shift out to meet the new money demand curve. So first answer here is we need to increase this money supply. And then we need to identify a monetary policy that can make that happen. So what can increase our money supply? There are three Fed policies here. The first would be our open market operation of buying bonds. Remember that your mnemonic device is that buy equals bigger money supply. So buying bonds will increase the money supply, putting money into banks and pulling those bonds out, allowing banks to begin loaning again. Second option would be to decrease reserve ratio. Decreasing the reserve ratio would increase the multiplier and allow banks to lend more money and turn physical dollars into more of those bank dollars moved throughout deposits and loans. And then your third option would be to decrease the discount rate, that rate at which the Fed lends to banks when they are in trouble, which would signal to banks that the Fed is prepared to help them when necessary. All three of these are choices that can increase the money supply and therefore decrease interest rates. Because this problem asked for just one monetary policy, on an actual FRQ or actual short answer question, any of these would be an appropriate response as long as we are able to link those three choices to an increase in the money supply and the decrease in the interest rate necessary to complete the problem.